That's an unbelievable thing. When Apple now is going to start building all of their plants here, all because of what we've done in terms of, it's not because he likes me or they like me. They don't probably like me at all. I don't know. I think he likes me a little bit at least. But you know what? It's the incentive we created, or the negative incentive. I mean, it's going to be very costly for people to take advantage of this country. They can't come in and steal our money and steal our jobs and take our factories and take our businesses and expect not to be punished. And they're being punished by tariffs. It's a very powerful weapon that politicians haven't used because they were either dishonest, stupid, or paid off in some other form. And now we're using them.
Have you spoken with President Xi about this term?
I don't want to tell you that. Thank you very much, everybody. Thank you. Thank you very much.
About Andrew Cuomo running for New York City mayor.
Will people who don't respond to the emails be fired?
President Donald Trump there walking out the door after making an announcement that was ostensibly supposed to be about a big investment by Taiwan Semiconductor into the U.S., $100 billion over the course of 4 years. But once we got to the Q&A session, the pivot back to tariffs that the president says are coming tomorrow, and that any negotiation by Canada and Mexico, well, that opportunity has passed. Romaine Bostick here alongside Alex Steele. This is the close. As we move closer to the closing bells, we are looking right now, Alex, at a market that has clearly made it clear it is not necessarily happy with the direction of some of these trade policies. The NASDAQ right now wiping all of the gains it got from that big Friday bump.
Yes, and also the idea from President Trump saying that there's no room left. It doesn't seem like there's an off-ramp until midnight tonight when those tariffs do come into effect. Taking a look at the NASDAQ, for example, down to the lowest since November. You're looking at NVIDIA, lowest since September. You have the Mag 7, lowest since November. Superlatives really picking up now across the board.
You saw a spike in the VIX while the president was speaking. You also saw an interesting spike in the dollar relative to the Canadian dollar as well as to the Mexican peso here. A lot of people now trying to reposition around, let's face it, something he basically made clear was coming, and now that day is finally here, at least in a few hours' time.
Which just begs the question, how do you hedge it at the end of the day? And the sentiment has already been so bad. Layer this on, sentiment becomes even worse. So who's the marginal buyer now at this point?
All right, let's bring in Mike Contopoulos into this conversation. He's director of fixed income over at Richard Bernstein Advisors. And Mike, I do want to start off kind of with this, what the broader sentiment is right now amidst all of this talk about tariffs and everything that goes along with that. Obviously, this has nothing to do with whether you believe these are proper policy. It's more about what the effect is on the economy, the effect on the markets, and how you position around it.
Yeah, that's exactly right. Listen, I think there's a couple things we have to keep in mind when thinking about some of these new policy actions that President Trump is implementing. One is tariffs are going to be inflationary. You saw that with the input price data this morning. I mean, you had a significant increase.
You're talking about that ISM manufacturing.
That's correct.
And the input costs.
That's right. If they can throw a graph up there, plot that versus CPI. And it's a very nice lead to CPI. So I think number one, this is going to have real implications for the Federal Reserve and interest rates. Number two, listen, we're going to potentially have issues around an inventory cycle, around sort of some of the impacts of tariffs and higher prices, et cetera, right at the same time that you're getting peaking profits. So there's a world in which we live where much of these policy decisions could usher in sort of a 2022 light period where you've got slowing growths, peaking profits coming down the other side, but the Fed's hand is forced with regards to tighter liquidity.
Let me ask you maybe a dumb question, though. Is this about the idea that these tariffs are coming, or is it just kind of the uncertainty around it? Because I've heard this argument that maybe if this was rolled out in sort of a more clear and kind of, consecutive type of way, that the market could have sort of adjusted to it. But it seems like one day he's going to do it. Maybe there'll be a reprieve. Maybe there won't. And then you talk about companies and manufacturers who are trying to run some of this stuff, which, of course, creates a lot of economic distortions.
Yeah, I mean, I think much of it has to do with the uncertainty, without a doubt, especially the near-term volatility that we've seen recently. I think when you look at February's equity markets and you look at what the 10-year did, you obviously had a risk-off environment, and I'm not entirely sure, based on the fundamentals, it was entirely justified. I mean, profits are still accelerating. You have, historically low unemployment rate. You look at the manufacturing data. Until recently, it was pretty strong. So yeah, you did have some disappointment on services and retail sales, but the data has certainly been mixed, I would say, to the stronger side, not necessarily the weaker side, especially when you factor in profit growth. Yeah. And so I think much of the defensive nature that we saw in February, staples and healthcare leading on the equity markets, Treasury rallying, was in reaction to the volatility more than the hard economic data. But the question I have is, okay, that's today reacting to the vol and the uncertainty, which is causing that vol, versus 3 or 6 or 9 months from now when it actually has a bigger impact on the real economy.
So just some headlines here. Foreign Minister in Ottawa is speaking, saying that Canada is ready to put tariffs on 155 billion Canadian dollars worth of U.S. goods. So these headlines trickling out now after President Trump said the tariffs will go into effect this evening. But 6-9 months down the road, the hope is that then there'll be tax cuts and there'll be less regulation, which will then help offset that any one-time impact from this inflationary shock. Do you buy that?
Listen, I think this is why it's very dangerous to focus on economics, which can be pretty nebulous, and there's a lot of factors that affect the macro economy. And instead, we should be more focused on what's going on with earnings growth. And if you look at earnings growth, I think it's pretty clear that you're likely entering into a peaking period. And at RBA, when we think about earnings growth, we look at year over year. So you obviously have base effects that are going to affect where you are on a year over year basis. And as you look out towards Q2, Q3, and then Q4, and perhaps even Q1 of 2026, you're going to reach a peak probably in the second or third quarter of this year. So when I'm sitting back as an equity investor or a credit investor, and I care very much about corporate profits, that I think is kind of indisputed, that you are going to see corporate profits start to decline, regardless of what's going on with the economy. Now factor in the potential impact of tariffs and everything else, and you could set the stage for what I would call an Act 2 to follow sort of an Act 1 of strong cyclical growth.
Okay, where do you hide?
So today I think you have to remain underweight duration. I don't think growth today is that bad, hence the comment about 6 to 9 months from now. And in a reasonably strong growth and inflationary environment, which I believe we're in, you want to be underweight duration. That doesn't necessarily mean cash. I think there's opportunities in structured products, CLOs, agency mortgage-backed securities, and then higher quality equities.
So, but is the idea, though, when we talk about lower duration, I mean, is that safety, though, even being at the shorter end at this point? Given, I mean, we talk about the volatility in equity markets. I mean, the bond market has kind of been like, hold my beer, and let's see what we can do.
I do think there is some safety in the front end of the market, particularly when thinking about, 10, 20, or 30 year, right, as the sort of the longer duration piece. I would not want to be overweight sort of the back end of the market, particularly because I think the market's going to continue to price in an inflation premium, even during the next slowdown. Whether that slowdown happens in 2025, 26, or 27, I don't think rates are going to fall at the 30-year space like they have in the past because of worries about longer-term inflation. You can see that, in break-evens as well.
So I know you're the bond guy, but you mentioned how you guys also look at higher quality equities. What does that mean at this point?
Yeah, that's a great question. I mean, when we look at higher quality equities, it kind of can depend, right? You want strong, stable cash flows. That can come out of financials, you could argue, are higher quality this cycle than maybe in the past, such as in 2008, 2009. I think you could look for higher quality equities and some high quality dividend payers, those companies that sort of have a record of increasing their dividend over a long period of time. I think you can find quality on the equity side, even within the industrial space, which we used to kind of call, a chicken cyclical. Now maybe financials are more the chicken cyclical than industrials, but sort of later cycle type stable cash flow companies.
All right, Mike, always appreciate the conversation. Mike Contopoulos there over at Bernstein Advisors. We should point out for the S&P, the only sectors in the green right now, Alex, are real estate, staples, and healthcare. And right now we are hitting session lows on the major indices. I mean, this is a pretty broad-based sell-off, too. I mean, some people are looking for pockets of safety, but you got NVIDIA down 9%, Amazon down 3%, Broadcom down 4%. And then even once you get down the chart to some of the other discretionary names, there's really no place to go right now.
No, and we are very close to almost erasing all the gains for the S&P for the year. We are definitely looking at the S&P falling the most now since December. And
you're also seeing a spike, of course, in the currencies, primarily with regards to dollar strength relative to Canadian dollar and the Mexican peso. The VIX elevated at 23, a lot more to to cover here on this show. Coming up, we are going to take a deeper dive into those tariffs scheduled to start tomorrow, which could send car prices up by some $12,000. A conversation about what that means for automakers like Ford.
And even crypto is souring on White House plans, with investors questioning Trump's proposal to put XRP and Solana in a strategic reserve. All that and more coming up. This is The Close on Bloomberg.
All right, let's get right to our top calls. Big movers on the back of analyst recommendations. And we start with Kinder Morgan, upgraded to overweight at Barclays, which says the natural gas pipeline company poised to benefit from its core infrastructure assets. She says Kinder Morgan's business remains on strong footing and provides ample cash generation, and also says the stock's current valuation is compelling. Shares fractionally higher on the day, though that will be a fourth straight day of gains should this hold. Next up, Chipotle raised to overweight from equal weight at Morgan Stanley. The analyst saying the stock's year-to-date weakness presents a buying opportunity into what he calls an excellent tech play. This comes as Chipotle increases spending to deploy autonomous tools and robots in its restaurants. Those shares also higher. Another bright spot here for a second day. And finally, Oracle, the software company. It had only one sell rating among the 40-plus analysts that tracked the stock. That one analyst throwing in the towel, Moniz Crespi, which cut his recommendation to sell in December, reversing course 2.5 months later, an upgrade to neutral, now calling Oracle a, quote, high-quality company set to benefit from cloud and Gen AI demand. Nevertheless, those shares down about 2% on the day. All right, those are some of our top calls. Let's turn back to the topic of conversation, tariffs, and now the auto industry. It's been feeling the pressure from those imminent tariffs against China, Canada, and Mexico. Car sales at Ford dropping almost 9% last month, and that was just amid broader inventory and pricing pressures facing the sector. And now that sector, relying on factories in Mexico, faces potentially staggering tariffs. We just heard the president himself say that the time for negotiation has passed. Emmanuel Rosner, auto technology analyst at Wolfe Research, joins us right now. Currently has an underperform rating on the stock. And Emmanuel, let's start off with the tariff question here. And we're talking about trillions of dollars of goods that cross the border between these two countries, and autos a big component of that. I am curious, is there any way for Ford, or for that matter, the other automakers, to somehow curb the cost impact on them, or do they just basically have to eat this?
Yeah, thanks for having me. So as you mentioned, it would be a considerable headwind for the industry. About $200 billion of goods across the borders between Mexico, Canada, and into the US on the auto side, both complete vehicles as well as parts. And so 25% tariff would be a $50 billion headwind that the various automakers and ultimately the consumers would have to shoulder. We hosted Mary Barr, the CEO of GM, at our Wolfe Autos conference a couple of weeks or so ago. GM's message is they could probably offset 30 to 50% of the headwind by just moving capacity around, by probably raising prices on consumers, things that they can do fairly rapidly without deploying any new capital, offsetting the rest of it, which could be anywhere between 50 to 70% of the hit. That would be extremely expensive. This would be about moving around factories. This would require a tremendous amount of investments and would take a very...
I'm not exactly sure what specifically the Trump and the White House has said on the existing agreements in place, but there was a lot of talk about some of the potential exemptions for local content rules. And I saw some data showing that of the 3.6 million cars and trucks, light vehicles that we imported last year, about 1.5 million of those met those local content rules to avoid tariffs. Any chance that we could see more of these companies trying to take advantage of that?
Yeah, up until now, obviously, USMCA had some content rules, and this is how this entire North American auto industry has been built. This is why parts go and across the border multiple times sometimes until they actually make their way into U.S. vehicles. And that's, this industry has very much capitalized on that. There has not been really much talk of that as part of these new tariffs. And so these 25% tariff seems to be much broader. We haven't heard any carve-out, specifically for the autos industry. We haven't heard any specific content rule that would enable, the autos industry or parts of it to be excluded. So this is all still very much TBD. But there's one very clear message from this industry. And Jim Farley, the CEO of Ford, said it at our Wolfe conference just a couple of weeks or so ago. this will blow a hole inside the autos industry. This is something that has the potential to be dramatically damaging, so much so that this industry hasn't really believed that it's actually going to happen. So very, very difficult, and very few carve-outs that have been discussed so far.
Well, that's definitely a statement. And you're taking a look at the stocks right now. The Ford is off by about 2%, GM off about 4.5%. GM stock has held up relatively well so far this year in relation to Ford. That's sort of been a straight line down ever since July of last year. What do you think is currently priced now?
So in terms of tariffs, not much. As I said, both investors and the companies themselves have sort of basically taken the stance of this is not going to happen. This is so bad, so damaging that it can't possibly happen. It would destroy this industry. So not much in there in terms of tariffs. If the tariffs were to happen, this would put tremendous pressure on the stocks, just like we're seeing a little bit today ahead of them. In terms of fundamentals, very, very different paths though between GM and Ford. GM is essentially guided for an incredibly strong year, $12 billion of free cash flow, buying back a meaningful portion of the companies through share buybacks. Ford is essentially under a tremendous amount of pressure, has a lot of fundamental headwinds, and so gave a very poor outlook for this year. So we're very cautious on Ford. We're much more constructive on GM. But again, all of that assumes that these tariffs are either not coming or become somewhat manageable.
Yeah, so where's Ford stumbling? Because the February car sales were down in the U.S. like, 9%. Where's the biggest hurdle here for Ford?
Ford is stumbling in multiple ways. First of all, it's built up a tremendous amount of inventory last year. Even as of the end of February, we're still talking about 100 days of inventories on dealers' lots for their pickups, 85 days or so overall for the company. So it's going to have to underproduce this year just to reduce inventory. It's also putting some pricing pressure. It doesn't have a real EV lineup, so it's still losing $5 billion in EV losses annually. No real room to improve that anytime soon. It also has a major cost disadvantage versus GM. It's paying much more in terms of quality issues, warranty, material cost, and it's really struggling to turn this around. And so we've almost reached a point where we worry whether its big dividend, which is really the draw for Ford, could be at risk if the free cash flow doesn't cover that this year. So we're generally fairly cautious on that, even absent any discussion around tariffs.
Ooh, okay. Wow. That would be something. All right, Emmanuel, thanks a lot. Really appreciate Emmanuel Rosner over at Wolfe Research joining us at the risk on the car companies, in particular when it comes to Ford. Here's an update for you. The sell-off is picking up some steam. The NASDAQ now off almost 3 full percentage points, down about 6% so far now for the year. The S&P is down 2 percentage points, remain now down by about 0.8% so far for the year.
NVIDIA leading that decline, at least in terms of its main point drag here, a 10% drop in that stock here this afternoon. We should point out TSMC, at least its ADRs in the U.S., also down 5 here. So that announcement by the Trump administration about that investment in the U.S., I guess kind of being looked past here, Alex Hill, as everyone focuses on right now those big tariffs set to take place at midnight tonight, 25% across the board for Mexico, 25% more or less across the board for Canada, though there is a minor exemption for some critical energy needs, but there's still going to be a tariff of 10% slapped on that.
Yes, absolutely. And taking a look at the S&P also in the technical levels here, obviously we were below the 50 and 100-day, but now the 200-day doesn't look so crazy. We're still about 100 points away, but still a very different setup than we were just about a week ago. Now the question becomes, are there marginal buyers for the equity market, and when do they step in? All right, coming up, we'll continue the conversation with tariffs with ABB. They're making a big investment towards U.S. manufacturing. We'll break that down with the CEO coming up next. This is The Close on Bloomberg.
.30 p.m. in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. We are looking at a sell-off that continues to pick up steam, specifically looking at some of the big losers within the S&P, Romaine. It's pretty much everything, but energy, tech, consumer discretionary, materials, industrials, all of that exposed to tariffs, the lowest of the session.
Yeah, and I mean, if you have a Bloomberg terminal, it's really easy to kind of sort out the companies that have outsized exposure to certain countries like China, Mexico, Canada. All those names are getting killed. Automakers in the red across the board. Chip stocks in the red across the board. Retail stocks. Remember, we're supposed to get a lot of retail level earnings, Macy's, Target, Costco, including some of the more individual retail companies. And of course, a lot of companies that are very reliant on getting exports from overseas, all those stocks deep in the red.
What's so interesting is we get this announcement from TSMC investing billions in the U.S.
Which seems like a good thing.
It's like a blink and move on, totally overshadowed by the negativity of tariffs.
Absolutely.
Well, speaking of building stuff here in the U.S., European engineering company ABB is now investing millions of dollars to boost its presence in the U.S. The company announcing today it's going to put $80 million towards a new facility in Tennessee and $40 to double its footprint in Mississippi. Now, the new endeavor is expected to create more than 250 jobs and is slated to open in 2026. We're very happy to welcome ABB CEO Morten Wierod, who joins us now in studio. Morten, such a pleasure. Thank you for joining us.
Thank you, Ryan.
So it's very trendy for CEOs to come in and say, we're going to invest a bunch of money into the U.S. Look at this. Is this at all related to the Trump presidency right now?
Well, it comes on a backdrop of many investments we've done here in the United States over many years now. But this is another expansion of our facilities. In ABB, we always want to serve customers where the demand is. And we have, now we're kind of catching up to that. More than 18% of what we sell here in the United States is already manufactured in the United States, and we want that to be higher. So it's another investment we're making now, especially into the field of electrification, serving the data center, but also the utility market of the United States. And we are going to, as I said, this is one out of many investments here.
And it's worth mentioning, you guys make the guts of things, so we can like turn on lights and like run a plant and run a data center. So it's all the guts that we need to run stuff. How do you view tariffs, for example? Like, I know that you make a lot of the stuff that you're going to sell in the U.S. in the U.S., but if we get tariffs tomorrow, what does that do to your business?
Short term, it will, and also longer term, it will not have the biggest impact. But of course, we're a company, and in general, we believe in free trade. So that would be our preferred way. But okay, now we deal also in the situation where we are now, and that's the kind of building resilience in every geography that we operate. And already in our main markets of Europe, of India, China, and the United States, we are in the 80s or even in the high 90s when it comes to the self-sufficiency index that we measure. And we want also here in the US to come and to be even closer to American customers, not just with manufacturing, but it's also with engineering and technology skill sets and the service and support through our partnerships what we have here.
What prompted that move? Was that always sort of the strategy of ABB to be kind of a little bit more disparate? I mean, you are a truly global company at a time where globalization, let's face it, is up against the ropes here. It's not just the U.S. sort of pushing back on that sort of post-World War II order. Are you truly prepared for the possibility that era is over?
Yeah, I think we are, because what we call our local for local strategies has been ongoing probably more than 15 years. Personally, I lived in China in 2008 to 12 to build up manufacturing capacity, engineering capacity in China. Today, we are in the mid-90s in China when it comes to self-sufficiency. We're doing the same in India over the last year with significant investments, and we've done here the same here in the United States over the last year, both with acquisitions through companies like Baldor and Thomas & Best, and later on the GE Industrial Solution business that was acquired by us, by ABB. But then in addition, it comes with a CapEx allocation here to the United States.
What's growth like? Because, I mean, Alex kind of mentions you guys are kind of the guts of everything. I mean, it's kind of like the company that nobody knows about that affects everyone's life. And I am curious that when we talk about energy transition and we talk about just this whole idea of whether it's electrification or just a cleaner way to run factories, run our apartment buildings and office buildings and our cars for that matter here, are you still seeing growth in that area, or are you worried that could be interrupted by policy changes that maybe are a little bit antithetical to that?
The world will continue to go electric.
You're confident?
I am confident. That is no way back. It's the most efficient way. And a lot of EVs got a lot of attention, but everything we do today in our buildings, when you talk about heating, moving from gas or oil heating to electric heating, that's happening. Looking at every building and how the electrification trend of everything which is in here, with automation and electrification, and the same in transportation. We're not going back to steam. We're going from diesel to diesel electric or to full electric. That's what's happening across the world, and also definitely here in the United States.
Throwing some coal on the fire here. Just some breaking news. The White House posts on X about Trump signing an order to tariff China at 20%, not 10%. I don't know if this also encapsulates another 10% down the road that was visible, but it looks like the tariff's going to be 20%, not 10%. Morten, when you take a look at that demand, I feel like if we had this conversation last year, we would have been talking about like EV charging networks, right? Or like solar panels and stuff like that. But now we're going to talk about data centers. Where are the weaknesses in your business, and where is the super strong strength? Yeah,
well, the super strong side is on power generation when it comes to integration of new energy. I mean, solar and wind renewable space has been there historically, but now we see more and more also gas expansion and LNG kind of as to boost that energy mound that we see there. Then it's all about distribution of energy in the electrical network. There is big investment in the United States now putting all the overhead line underground due to forest fires in California, due to all the hurricanes we have on the other side, on the east side of the coast. This is driving the whole power grid and what is needed of investment so we can get better reliability in the power grid. So people don't need to run their diesel generator, but can have electric power every day, even after a hurricane. And then it's all about the use of electricity and in the field of automation, in the field of infrastructure. And that's when we're looking at what's happening in the water and wastewater space, everything also around on the port and marine infrastructure. So all of these areas, there is an electrification and automation trend happening, and that's we as ABB are in the midst of that transition when it's happening. And then from the next step now is also to see we can accelerate that change. It's not only about electric cars when we talk about charging, but a lot about like bus fleets and electric buses. Yeah. That is happening, and you see in many cities here in the United States. So then we'll see how the adaptation of EVs comes along. But that's a pretty small part of the whole electrification trend of society. So it's one, but it's not by far not everything. Yeah.
All right, Morten, this is a great conversation. Glad we could have you here in person here in the U.S. Morten Wierod, he's the CEO over at the big electrification and automation giant ABB. As we keep an eye on the U.S. markets, Alex, counting you down to those closing bells, just 20 minutes away, and we are still at session lows, fresh session lows, with the NASDAQ composite right now down 3% on the day. Is this the washout we've been waiting for? Is this the capitulation feel, or we got more to go? I mean, it's hard to say. I mean, how many times have you asked me that question and we've said, of course, and then the next day you get a big rally that kind of just says, okay, whatever, it's a dip buying opportunity. But there are a lot of concerns here about the economic impacts. You read out that headline just a minute ago. I thought we were getting 10% tariffs on China. Maybe it's 20 now. Now we're getting 20%, and I think that's, Mike Contopoulos was referring to that. It's kind of that the volatility in the policy message is creating a lot of the volatility in the markets. Which begs the question, who was going to step in and buy based on that? Yeah, speaking of which, if you are looking for a safe haven, you're not going to find it in crypto. This was supposed to be kind of the week where crypto shined. After all, a big White House summit coming up this weekend. And of course, and that was on the back of some favorable comments that Trump made over the weekend about a strategic U.S. crypto reserve. Nevertheless, Bitcoin down 9%, Coinbase down 5%, XRP down 18%. A deeper dive here into some of those moves coming up next on The Close. This is Bloomberg. Time now for our stock of the hour, and we're taking a look at crypto stocks. 24 hours ago, this screen would have looked way different than what it looks like now. Bitcoin staged a 9.6% rally on Sunday. Today, it's down 9.6%. A lot of optimism over the weekend here about President Trump regarding a strategic crypto reserve, and of course that big White House crypto summit, the first ever, scheduled for later this week. Bailey Lipschultz joins us right now, who covers equities, covers markets for us here at Bloomberg. And Bailey, kind of package this all up. You kind of had some hope here. Trump said strategic crypto reserve, that's going to be a thing. We've got a big White House summit coming up this weekend. Everybody was all in. And now, as the day went on here, people bailing out of some of these coins and bailing out of some of these stocks.
Exactly. When you look at Sunday, that post on Truth Social, followed up by another post that he also still loves Bitcoin and Ethereum, fueled rallies in those tokens. Big thing, though, is that obviously crypto trades 24/7, a little bit more less liquid on the weekend, so you can see some of those big rallies. To your point, though, everyone woke up clear-eyed on Monday morning and thought, wait a minute, there's not much substance there. Yes, we're getting excited for this one-of-a-kind kind of symposium, if you will, at the White House later at the end of this week. But just because he's kind of reiterated the game plan that he laid out, is this the U.S. going to be pumping money into these tokens? Are they just going to be taking confiscated tokens and holding them on a hard drive? There's so much uncertainty around what that means. And we had quickly seen some of those trades unravel. And obviously, when the market is under the pressure that it is right now, a lot of those exchanges, Robinhood, Coinbase, MicroStrategy, now known as Strategy, are all under pressure just given they are exposed to the riskiest of all risk assets. Well,
and then also begs the question, it's a tough tape, right? So who knows what would have happened if we didn't get the big sell-off in the equity market as well. I guess my other question is, what part of the crypto world makes sense to have in a strategic reserve, and what part is just like a technology platform, in which case, like, can we just go own Amazon instead?
I don't know, Alex. I don't think anyone knows.
This is a fair point.
I think it's the question comes back to what is the reason that there would be a strategic reserve, and what are they going to hold? Is it stockpiling gold? Obviously, the whole kind of crypto ecosystem wanted a digital Fort Knox, if you will, coming out for Bitcoin to be bought up, and that's something that Michael Saylor has talked about. But what is the actual utility? And that's really been kind of the sticking point.
I thought Fort Knox wasn't safe. Didn't they steal all the gold or something? I was told.
In
all seriousness, though, we talk about this idea of what crypto assets are even supposed to be. And I know we've had this debate ad nauseum. Is it just a speculative asset? Is it a hedge? Is it blah, blah, blah? But it gets to this idea that when we do have these major risk-off days, it always seems that crypto seems to kind of get caught up in it one way or the other, despite the fact that it is supposed to provide maybe some defensiveness.
Well, and that's always the debate, and that's been the debate going back to kind of the first excitement back in 2015, 2016, is when it's up as a hedge for inflation, it's utilizing its utility as a hedge, and then when it's down on a risk-off day, all of a sudden the bears are actually right, and it's always been speculative. So depending on what the tape looks like, that's really what you see play out.
All right, Bailey, thanks a lot. Really appreciate it. Bailey Lipschultz joining us there from Bloomberg. Talking about the tape, it is tough out there. You're looking at 3.2% sell-off within the NASDAQ remain, S&P down 2.2%. Money moving into the bond market, moving into the yen, different areas of the dollar as well. We are almost close to breaching the 10-year yield at 4.14%.
And back in markets, you're looking at a Philadelphia Semiconductor Index down 5%. XOP down 6%. Home builders as a group down 3%. Financials, remember they were the bright spot last week. The KBW Bank Index right now down 2.5%.
Despite the fact the FDIC might actually make it better for bank regulation.
So I'm told.
Who knows? Yeah. Coming up, Kristen Bitterly of Citigroup will be joining us to take us through this closing bell. This is a close on Bloomberg. All right, this is the countdown to the close. We're about 10 minutes away. Romaine, taking a look at the market sell-off, picking up steam to the downside. Quite a day.
Yeah, and it's kind of interesting, too. We talk about this idea sort of whether there are safe havens. Are you seeing somewhat of a bid to some of the healthcare stocks and a few of the staples here? But this is a pretty broad-based sell-off, more than 70% of the S&P in the red. But it's really more about some of those high-value names and, quite frankly, some of the names that have really led this market higher for the last year and a half or so. You look at a NASDAQ 100 off the lows of the day, but still down 2.5%. And whatever happened to that big rebound rally, that dip buying rally we saw on Friday, those gains have been completely erased.
Is this capitulation? Is this what the market has been waiting for, or do we have more to kind of shake out at this point?
Well, based on how the market is reacting, I'm not sure they were waiting for this. It seems like they're surprised by these tariffs that Trump has basically said for months now he was going to impose. And now that day is here, at least for 3 of these countries. And it looks like that's going to go through, barring, I guess, some last-minute negotiations.
And money coming into the dollar, depending on the cross, but also the 10-year yield now down to about 4.15%.
Absolutely. Here, let's get Kristen Bitterly into this conversation. She's the head of wealth over at Citi, joining us right now. Wealth at Work over at Citi, joining us right now. I had to get that right. Sorry, you're head of wealth. We'll get the way this market's going. You might need it here. I do just kind of want to get your take, and this is kind of to Alex's question though too, as to why the market reaction is so severe. I mean, Trump spent a year and a half campaigning on this. Since he's been in office, he's made it clear that he planned to go through with these tariffs, and we knew there was this 1 month reprieve, but there hadn't been a lot of discussion about negotiations in between. That day is here, and at least based on what Trump said about an hour and a half ago, there's no more room left for negotiation?
So a couple of things. I think one of the conversations we've been having is this really a negotiation tool to bring people to the table? I think on Friday, the rally that we saw was that most likely, most market participants were thinking that Mexico and Canada would not go through. I think China, the general market consensus is that would be on the table since no one was at the table. And so what we're finding is the market is trying to parse through what is the reality. So trying to separate the headline from policy and the reality. And you can see that many people weren't positioned for this.
The big question, though, is sort of what becomes of the ripple effects on the economy, and more importantly for corporate financials. We're coming off an earnings season that I know the bar was low, but I mean, most companies sort of met that bar or better. Even some of the guidance that we got out of the companies was relatively encouraging. Do we need to start pricing in the idea that there could be an economic drag that could have an impact on those bottom lines?
So maybe we divide into how did we start the year and where are we today?
Okay.
We started the year with a pretty robust backdrop. We saw earnings broadening out. We saw a lot of the sectors actually pivot to earnings growth. You have a ton of cash on the sidelines, the $6.5 trillion that everyone quotes. You had peak rates and disinflationary forces. All of those things were really good. Right now, what are we getting? We're getting this kind of slow drip of economic information that is causing us to question some of this. So whether it's jobless claims, the employment backdrop, the headlines out of the government saying that there's going to be layoffs, understanding how is that going to flow through to the economic data, and adding in tariffs, is all of this really just a hamper on growth? And so if there's a slowdown in growth, that's a very different economic place than where we started the year.
Right. So if I say buy the dip, is that a no? I mean, because this could also be a phenomenal buying opportunity, right?
Recessionary, though. I think that's the other thing is, so like the data that we have right now is when you look at our economic surprise index, it's coming in below expectations. It doesn't necessarily mean that it's contractionary. So any one of those data points, I don't think is concerning in and of itself. It's just the amalgamation of it. And so I think when you look at tariffs, when you look at the immigration policy, when you look at all of those things that the market is actually reacting to, it's a slowing in growth, and that's the reality of it. But I would say if you're going to buy the dip, you want to buy into quality. So when you're looking at the opportunities to buy in, large cap, you're looking at some of the free cash flow generating stocks, you're going to want to buy in at companies that can withstand, because this volatility, while we would love to say it's short-lived, this is something that's going to be with us for a while.
So does that include like the sexy Mag 7 stocks or no?
I think there could be some opportunities just from sheer balance sheet. So the sexy Mag 7 stocks, obviously that's been the part of the market that has suffered the most, starting with DeepSeek and then actually moving into, even if you look at the market action last week over week, if you look at the S&P 493, it was positive on the week. So they have certainly been punished, but it was more because they were priced to perfection. And I think the other thing is no one's looking at, some of those stocks rallied 100% since Trump was elected into office. And so giving back a normalization of some of those gains, but strong balance sheets, free cash flow generation, given all of those headline concerns and trying to navigate through the policy uncertainty would be a good place to buy in.
I am curious what your clients are asking you, because I mean, Alex and I, we get paid to freak out every day. The market, goes up or down, a fraction of a percentage point. But are real people, I mean, meaning, your clients, are they that in tune to this, meaning reactionary to this, or are they just kind of saying, not really concerned?
So within wealth management, most of our investors are playing a long game. So they are trying to figure out, given their timeline, how should I be balanced? How should I be positioned? And we all know about the perils of market timing. So taking a look at today and saying, I'm either going to be all in or all out, that doesn't benefit anyone in terms of their long-term wealth goals. But that being said, I think there is a lot of inertia. I think it's one of those things where we saw the data around consumer sentiment, consumer confidence. Anyone delaying decisions, so whether that's a consumer, whether that's a corporation, that's stuff that then can influence corporate earnings as well. So people are asking those questions.
But the sentiment is important, too, because we talk about this idea how all this drama that we've seen in Washington hasn't shown up necessarily in hard data, has shown up in some of the survey data. And I thought we had Lori Calvasina over at RBC, was on Bloomberg. She talked about that we're kind of at the beginning of this sentiment shock. You've seen it, obviously, in the consumer sentiment surveys, and to a certain extent, it's starting to show up in some of the business surveys. And I wonder, how does that end up feeding through into the actual market behavior itself?
I think where it will end up feeding through
Yeah.
is actually how we're positioned in our own portfolio. So if you look at how we're positioned, we saw a lot of value in fixed income. There's been a ton of volatility in fixed income. There's arguments about whether you should be significantly overweight equities versus fixed income. Just given the sheer yields that you could capture there, we had significant positions in fixed income. And I think that's been a major benefit year to date in terms of some of the movement in rates that we've seen. So diversification is your friend here. What I would say is in the wealth management industry, you always have to take a step back and say, how am I positioned and is my portfolio prepared for these types of events? And so you don't want to make that knee-jerk reaction of all in, all out. But if you can say, I have a diversified portfolio with fixed income exposure that if there's a flight to quality, that's going to benefit me. And then within my equity portfolio, do I have that bias towards these strong free cash flow generating companies that can really withstand pricing pressure, some of the tariff impact, and really navigate the policy uncertainty? It's a good place to be.
That was very soothing, Alex.
I know,
I actually feel better.
Yeah.
Do you guys want to open an account at Citi?
All right,
Call us anytime.
All right, well, there you have it, the sales pitch from Kristen Bitterly, one of the best in the business. Citi head of wealth at work here, providing a little bit of levity here on a day that is anything but. We're off the lows of the day, Alex, but still deep in the red.
Oh, yeah. Looking at tech, energy, consumer discretionary, materials, industrials, all lower for the S&Ps, with the real cyclical names being taken out here. And the bid into the bond market continues as we head into the close, Romaine.
All your favorites are lower, including NVIDIA, Amazon, and Microsoft. The full breakdown starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele taking you through that closing bell. A global simulcast starts right now. Scarlett Fu in the TV studio. Carol Massler, Tim Stenovec in the radio booth as we welcome our audiences across all of our Bloomberg platforms to parse the most crucial moments of the day. And Carol, it's been quite a few. The vibes really off. I don't know if it's because of the economic data, if it's because of the tariff discussions, or maybe just everything in between.
I would say yes, yes, and yes. And I think what's really interesting, yes, obviously what we're seeing in the equity trade, but you look at what's going on with the U.S. Treasury curve. I mean, to see 393 on the 2-year note, lower on the 10-year, just all along the curve, Scarlett. We were just talking with our Enda Curran, who watches the global economy. And, slowly we're starting to hear maybe more people talk or say the R word, recession. Maybe he said not there yet. But just interesting to see kind of a change in tone today.
Yeah, maybe the ISM manufacturing number that came out this morning kind of gave us a hint of what was to come, right? Employment and new orders contracting, and the growth in manufacturing slowing down, almost stalling. That kind of looks like stagflation.
Look what's happening to semiconductors today. On a day when we hear this announcement from TSMC and President Trump, you got NVIDIA down 8.7%, you got Broadcom down 6.3%, the stocks as a whole down 4%.
But to be fair, we also had the chips down, particularly NVIDIA earlier, unrelated to any of this, as you have certain entities looking into the fact whether Supermicro, for example, had NVIDIA chips, and that made its way into China. So there was already something separate that was weighing down on that chip sector.
Yeah, absolutely here. But again, no real sector spared today. A few bright spots out there, but they are middling to be sure. The good news is we are off the lows of the day by a big amount. The bad news, all of those gains that we saw in that dip buying rally on Friday have effectively been erased. The Dow Jones Industrial Average lower by more than 600 points, or 1.5% on the day. The S&P lower by about 100 points, or 1.8%. The Nasdaq Composite down 2.6% on the day. The Nasdaq 100 down 2.2%. But here's your big lagger. You're going to find that in the small and mid-cap space. S&P 400 mid-caps down 2.2%, and the Russell 2000, the small caps, down 2.8%.
Yep, going back to the big caps, if I may. And you're right, we are definitely off our lows, Romaine, of the session. It was looking a little bit more dire about 15, 20 minutes ago. Having said that, look inside the S&P 500, 335 names to the downside, Scarlett, 166 to the upside.
All right, let's take a look at the IMAP, which looks at the S&P 500 based on the 11 industry groups. And no surprise here, tech, the leading decliner, off by 3.5%, matched only by energy, also down 3.5%. Consumer discretionary, which includes Tesla and Amazon, down by 2.3%. The outperformers here are the little slices of green that you see there. REITs, staples, healthcare, utilities, classic defensive sectors.
All right. And so I thought I had 3 gainers, but it turns out now I only have 2 gainers.
That's what happens on a day like today. You know?
All right, let's go to Capri Holdings. That one, first of all, certainly has been an outperformer in today's session. It's up about just shy of 4%. It was up as much as 9% earlier in the session, but finishing the day with about a 3.9% gain. This is said as Prada is said to be moving closer to a deal to buy Capri's Italian luxe brand. You may know it as Versace, after agreeing to a price of nearly $1.6 billion. So
what's it called?
Versace.
Oh,
Versace.
okay.
Did I say it wrong? Versace.
I'm American. I say Versace.
Me too.
Versace.
That's okay. Carol's
All right.
fancy.
All right. Versace. All right. Let's go to Allegro. I knew, as soon as it came out of my mouth, I'm like, didn't come out right. Allegro Microsystems. Let's hopefully get that one better. Up as much as 22% today, finishing with a gain of about 15%. It's a semi-manufacturing device company said to be drawing takeover interest from larger competitor on semiconductor, according to folks in the know. And it might be that some companies are interested in bulking up their automotive capabilities by looking to buy this company. But that was definitely an outperformer. And then Palantir, well, I don't have to do it because it actually turned into the red.
All right. Well, I'll add another honorable mention here. This is in the after-hours trade. Okta shares up about 8% here after fourth quarter EPS came in slightly above street estimates, 78 cents a share. The street was looking for 74. Revenue also came in slightly above street estimates at $682 million. Here's your forecast for the full year of fiscal 2026. The company sees adjusted EPS in the range of $3.15 to $3.20 a share. The street on average was looking for $2.92, so even the low end of that range well above what the street was looking for. A similar story when it comes to their revenue guidance, $2.85 billion to $2.86 billion. Street was looking for 2.8 even.
All right, a bright spot. We'll see if it holds for tomorrow's session and certainly after the call. I do want to get to some of the laggards in today's session, starting with shares of NVIDIA falling 8.8%. It's the worst performer in the Mag 7 today, the biggest drag too on the S&P 500 and the NASDAQ 100 by a long shot. Alex mentioned this. Singapore investigating whether Dell and Supermicro servers shipped to Malaysia contained NVIDIA chips barred from China, highlighting the role of middlemen in funneling high-end semiconductors. The risk-off sentiment that developed throughout the session today, not helping NVIDIA at all either. It's actually at its lowest level going all the way back to September and down just about 25% roughly from those highs back in January. And Sonova Energy falling today by 64%. It's the solar energy company. Shares tanked after they said there's substantial doubt regarding its ability to continue as a going concern for a period of at least 1 year from the date that it issues its consolidated financial statements. The company also removed its guidance, according to a presentation. And ADRs of TSMC, Taiwan Semiconductor, down today by 4%. Just keep an eye on those shares after the company announced that it plans to invest an additional $100 billion in U.S. plans to boost chip output on American soil and support President Trump's goal of increasing domestic manufacturing.
All right, where do you go in a market like this? You go to the safety of the bond market, bid all across the curve. Taking a look at that back end, the 10-year yield falling to 4.16%, a really strong move here. Ira Jersey of Bloomberg Intelligence, he heads up a U.S. strategy there, says that 4.13 is a pivotal point that could shake out a lot of other investors. So if you break that level, maybe a lot more buying to come. So just kind of watch that space. But overall, you have to see, guys, I have to say, wouldn't you have expected the bond market to be down like 10 basis points, 12 basis points on this?
Yeah, I mean, I thought it was interesting, too. I mean, you did see a little bit of a bid come into other safe haven assets, but it gets to this idea here of where is there to hide right now, because at the same time, you talk about the safety of bonds, Alex, but you're still dealing with other issues that could actually affect the valuation of that, such as our budget issues and other things that aren't directly related to trade or tariffs. So it does kind of become, I don't know what the euphemism is, whack-a-mole or whatever, where you're sort of looking for somewhere to hide, and then you pop up and realize that, oh, here's another policy thing that's going to just cut us at the knees.
Until today, people might have said crypto as of yesterday with that announcement of the strategic crypto reserve coming from the president, but there's a lot of skepticism and questions around what that actually looks like.
Did Tim just ignore my quip?
No. I didn't hear what it said. I would never ignore you. Please repeat it.
Another area of safe haven has been European stocks. The stock 600 closing at a record high, up 2%. You also see European defense companies. They've been on a rally all month, and that continues because now you have London and Paris talking up about increasing their military spending. The Swedish krona in particular has proven to be a safe haven as well. Big moves on that currency because that country's defense industry is seen benefiting from more spending.
Yeah, not about U.S. exceptionalism, but maybe European exceptionalism, at least at this point. Hey, I will say one other place to hide was gold today. It was up about 1.9%. So, certainly a safe haven play, or if you're worried about what's going on in terms of the economy or inflation, I don't know if that's the case today based on the economic data, but nonetheless, you did see some movement into that.
GitLab, those prices, that company is out with earnings, and application software company. Just taking a look here real quick. Revenue actually beats estimates for the fourth quarter. Taking a look at its fiscal year, though, for 2026, their revenue could come in anywhere from $936 million to $942 million. That's missing estimates. Also taking a look at adjusted earnings per share. On the high end, they see 72 cents. The estimate was for 82 cents for the year.
Yeah, I do want to go back to also just kind of the tariff threat, if you will, the idea that all this is going to come down the pipe. Trump, of course, in that statement standing alongside the TSMC CEO, which is ostensibly about investment here in America, basically saying that the time for negotiation is over. Now we're getting word from Canada, a story crossing the wire saying they've already prepared a sweeping package of counter tariffs. And that's a big part of this. We kind of forget it's not just about the tariffs we impose and what that means for the folks trying to import goods, but also the retaliatory tariffs and how that affects the companies that are making stuff here, but of course want to export them across the border or across the world.
We had an interesting chat with Keith Naughton specifically about autos and the way that auto prices could be affected. Some analysts saying that some auto prices could go up by $10,000, $12,000 per vehicle. And Keith kept mentioning the idea that these would be temporary tariffs. And that's how the automakers are thinking about it, because there is this off-ramp when it comes to border security that the president has given for Mexico and for Canada that doesn't necessarily exist with tariffs on China.
All right. We could certainly go on and on, but I'm sure we're going to have some of the similar conversation tomorrow. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We will see you again. I know, Alex, you're heading out. Scarlett's continuing with Remain on TV, and Tim and I continuing right here on Business Week on Bloomberg Radio.
All right, we're continuing to monitor the fallout from the sell-off in equities today. The S&P 500 losing ground by 1.8% off the lows of the session, but still a pretty large decline across the board here for equities. Let's bring in now Jeremy Siegel. He is Professor Emeritus of Finance at the Wharton School of the University of Pennsylvania. Jeremy, it's good to speak with you. How much do you read into this sell-off today as simply the knee-jerk reaction to President Trump saying these tariffs on Canada and Mexico, they're going to go ahead and take place tomorrow?
Well, as we know, I mean, the tariffs were always the bête noire, the unfavorable worst part of Trump's whole economic package, which everything else, about it, market-liked, lower taxes, less regulation, everything was good, but everyone knew the tariffs were the one thing that they didn't like. Now, let's all say, he could turn them off at 11:59 tonight. But if they've already prepared retaliation, and if it goes through tomorrow and we see Canada and Mexico retaliate, it just comes at a very bad time. I mean, we are getting weaker economic data in January. I mean, it's not as weak, I think, as the Atlanta Fed has said, but it is maybe 1% GDP, and that would be the worst in 2.5 years for the first quarter. And if the tariff hits with the psychology and all the rest, I don't see how it can lead anything good for the economy or the markets.
Yeah, you point to the data, the Citi Economic Surprise Index falling to a 6-month low, and you look at the ISM manufacturing numbers today. I know it's a survey, so it's soft data, but certainly it kind of points to worrying signs, right? You have employment going into the red. You also have new orders going into the red in contraction mode, and growth in manufacturing slowing down to a stall level. Talk a little bit about the psychology of these soft data points and what it means for how the Federal Reserve thinks about positioning itself.
Yeah, and the Federal Reserve is going to be in a bind. And let me say, when we were getting, even before this, tariff announcement today, we were getting weak consumer confidence numbers, both from the Conference Board at the end of February, University of Michigan. So already there was a dent in confidence, not a collapse, but a dent. But we know the mainstream media, which is not all that fond of fun, is going to have a field day with this, and any price increase that we get is going to be blamed on Trump, and that certainly is certainly going to be a negative on the market and a negative for the economy.
Well, but I mean, when we talk about the blame, though, I mean, and we talk a lot with you in the past about how markets kind of run on narratives, and we know if Trump is good at anything, it's about spinning a narrative that's more favorable to him. Talk about just like a bifurcation of markets and the economy, which technically are two separate things, and in theory shouldn't be as intertwined as maybe we make them out to be. But has that sort of I guess, connection become a little bit stronger given the narratives and how they overlap with each other?
Yeah, well, let's put it this way. The market has never really been able to ignore a recession. I mean, I think that, most of the bear markets come with economic slowdowns. And when there is a recession, I think it's 90% of the time it would be accompanied by a bear market. Now, I'm not saying we're going to have a recession, and we're not looking at that yet in the cards. But once you get a macro move in a business cycle, the stock market is almost never able to look beyond it. So you no longer get a disconnect, that the economy could be sinking while the stock market continues to enjoy, higher and higher prices.
So, Professor, though, if someone does believe that we are headed, even not necessarily a recession, but just to maybe economic softness, let's call it, and obviously some sort of meaningful impact to corporate earnings here, is there a defensive play right now? I mean, can you rely on treasuries to be that defensiveness, particularly at a time when we're dealing with our own issues budget-wise? It could have a significant impact here on where yields and prices go.
Well, certainly, there's no question that bonds have been good hedges in economic turndowns and economic slowdowns and economic recessions. Now, with the yield approaching 4%, it's not really attractive when inflation, is barely tamed at 2.5%, and if we have tariffs, it could reach 3.5%. I mean, that means that really you're holding a bond and you're getting 1% over inflation. I mean, it's defensive in the short run, but it's going to be a real drag on your portfolio over the long run. Right now, I'm not advocating people to, sell out. I don't think stock prices are that extended, and I'm excluding the Mag 7 here because they seem definitely to be in a slowdown. But the rest of the stocks outside of the Mag 7 are selling at 18 or 19 times earnings. 18 probably today, and that is not an unreasonable multiple. A long run, that's a definite positive hold.
All right, Professor, always appreciate you taking time for us. Professor Jeremy Siegel over at the Wharton School of the University of Pennsylvania, as we keep the focus right now on the tariffs and the potential impact on this market. Those tariffs set to take place in just under about 8 hours' time. This after President Trump made clear earlier today here that there was no room left to negotiate. This also comes just, a day before his big address to Congress, what is traditionally called the State of the Union address. Of course, this year, being Trump's first year, has a slightly different tone to it. Jonathan Lieber joining us right now, Eurasia Group Managing Director and Head of Research. And Jonathan, we focus so much on the U.S. side of this equation. We've already heard from Canada saying they've already prepared a package of retaliatory measures. Melanie Joy, the foreign minister, saying, look, we're going to start off kind of on a tranche system here, 30 billion CAD to start off, and that could ramp up in a big way to 125 CAD if, in her words, Trump doesn't reach a deal with them. Where exactly are we right now?
Yeah, I mean, every country in the world has been preparing for this moment and hoping to avoid it. So Mexico's done the exact same thing, thinking about where they could retaliate that's going to hurt the U.S. economy the most and cause Mexico the least amount of pain. But the reality is these tariffs are bad for everyone. And I think even at this late date, it's not 100% sure that the tariffs are coming in place tomorrow. Trump could change his mind later tonight. We know that his White House advisors, including the Commerce Secretary Howard Lutnick, are scrambling like crazy right now to get him to back off of these threats, presenting other options short of the 25% tariffs that he's looking at doing. And just the uncertainty here is incredible that it's even coming down to the wire.
I am curious, though, who really has the leverage here? Because the narrative is pretty clear. We're the world's largest economy. We basically have the cudgel stick, if you will, so we can kind of bend everyone to our will. But you're seeing a lot of countries kind of look at us now, look at this country and say, well, maybe we don't have as much of an upper hand as we thought.
I mean, the U.S. is the largest consumer market. It's the largest trading partner for Canada and Mexico. It's an enormous trading partner for China. I think Trump's diagnosis of the case that the U.S. has a lot of power here is correct. I mean, Mexico is completely reliant on the U.S. for trade. 80% of their exports come into the United States, and they've shown a willingness to do almost anything they can to avoid these tariffs. But the fact of the matter is that once you go too far, you risk kind of killing the goose that laid the golden egg. And Trump's tariffs are going to be destructive for the U.S. economy. You look at energy. Energy is one of the biggest things that the United States buys from Canada. Even a 10% tariff on energy is going to have ripple effects throughout the Midwest, where a lot of consumers buy that Canadian oil.
And to follow on that idea that the U.S. has a lot of leverage, Trump has said that the U.S.'s economic strength gives him leverage in any kind of trade talks. But if we do have evidence that the U.S. economy is starting to slow down, not growing as quickly as we once thought, even just a month ago, to what extent does that reduce Washington's leverage?
I just don't think it does. I think that whatever happens in the U.S. is much worse for U.S. trading partners. Now, China's been behaving as though they don't care about these tariffs. 10% tariff, no problem. Even a 20% tariff, they seem not to care about. So China's been preparing, and they've been preparing their exporters for this day when they knew that they could rely less on the U.S. market. But for Canada and Mexico, at least, the reliance on the North American market is tremendous. And they don't have a choice here, even if the U.S. economy starts to slow. If you look at the growth projections of what a 25% tariff on Canada would mean for Canadian growth, it means the unemployment rate shoots up. It means growth goes to zero just for the tariffs alone. So that's a much worse hit for Canada. But the problem for Trump is going to be once the economic effects start being felt here and you start to see consumer sentiment turning against him and his economic program, that puts him in a different situation. We know he's going to have to back down from this eventually. We don't know when or how long that's going to take.
So obviously, in the meantime, we're going to continue to pay attention to anything President Trump says, along with the other foreign leaders as well. And I guess what I want to hear from you, John, is when we see how foreign leaders behave when they come to the U.S., they appease, they flatter. Look at Macron, look at Starmer. How do you read between the lines to get an understanding of what's really happening? I mean, how much of their words can you take at face value? Can you take what Trump says at face value?
You definitely can't take what Trump says at face value because he changes his mind all the time. And his staff is trying to push him in a new direction all the time. That's the whole premise of the minerals deal that the White House was trying to strike with Ukraine, was by getting Trump, by kind of manipulating Trump into getting skin in the game, they could get him to buy into the Ukrainian defense that previously he hadn't really been that into. But Trump changes his mind. And at the last minute, we saw on Friday, that deal was ripped up. Today, I still think there's room for Canada and Mexico to get out of these tariffs or at least find a less severe blow. And when it comes to foreign leaders coming into the United States, they are much more prepared this time around than they were in 2017 when Trump first came into the White House. Yeah. Like you said, flattering him and using every tool they have to get him on their side.
But what good is that, though? I mean, we talk about this idea of any potential deal that could be. I mean, we had a deal. I mean, the USMCA, that was Trump's deal. And Trump himself has effectively ripped that up and said, 4.5 years later, no, that's not a deal. So if I'm Canada, if I'm Mexico, and I'm going to enter in another deal to stave off these tariffs, I mean, what's the permanency of that?
Yeah, that's a great point. Yeah. You look in particular at what Claudia Sheinbaum's been doing in Mexico. So Trump says, look, we've got a fentanyl problem, we've got an immigration problem, and we got a cartel problem. So what does she do? She cracks down on immigration, she extradites a bunch of cartel members, and she does something to stop the flow of fentanyl over the northern border of Mexico. And what happens is they get hit with 25% tariffs tomorrow, if you believe what the president said today. So it's a difficult situation for world leaders to be in. I don't see how you navigate this. You just kind of have to cross your fingers and hope he gets distracted by something else.
All right, Jonathan, great stuff. Jonathan Lieber of the Eurasia Group. And be sure to tune in tomorrow. The president's scheduled to give that address to Congress. Our Balance of Power team will have special coverage of that address. Well, I'm sure he will address the issues with tariffs and trade. And of course, as we sort of try to assess the economic and political impact of it, the market has to assess the impact on the bottom line as well, particularly if you're a small or mid-cap company, companies that are much more exposed to those tariffs than any other segment of our economy, given their focus out there. But not all companies are set to mitigate those risks. Some of those companies are in the infrastructure capital ETFs. With products in small caps, real estate, and MLPs would have some significant tariff exposure. Let's get right to Jay Hatfield. He's the CIO of Infrastructural Capital Advisors. He joins us here on set. Jay, great to have you here.
Thanks for me.
Sorry, I just want to reframe this a little bit here because we're talking about the impact that this could have on companies. You guys have a lot of products out there, including some small cap ETFs, as well as some other ETFs that do have a lot of companies that do have significant exposure to imports, exports, and the potential of tariffs here. Do you make an adjustment now in those ETFs, or is this not going to have as much of an impact as maybe we're making it out to be?
Well, we're a little bit more focused on what Charlotte was referring to, which is you have a super tight Fed, really ultra tight. They're shrinking the money supply by 5%. We think the market rate for the Fed funds is 2.75. So we think rates will come down, and the real big dynamic will be really what you're seeing right now. When rates come down, big cap tech gets slaughtered, the indices get slaughtered. Small caps can underperform, but we think they'll do well.
Yeah.
But you're right, they're not, some people say, oh, well, they're all domestic companies, but it's not really true.
Yeah.
For mid-cap companies, they do have exports and they are exposed to it.
There is a lot of exposure. I'm curious, though, just on the theory of rates coming down and the market. I mean, we've seen this started to show up in options positioning and then CFTC data as well. The Fed has been pretty clear that they don't want to sort of pre-react, if you will. They want to wait to see the impact of these policy moves on the economy. Something that we've been talking about here hasn't actually shown up in the hard data. So what gives you the confidence that Jay Powell will sort of signal, okay, we are ready to maybe pre-react to this and start to trim rates, or at least give the market the signal that they're ready to trim rates?
Well, we don't really think it's pre-reacting. We just think the Fed's always behind the curve. They follow an index that's 2 years behind the curve. So we actually publish the real-time PCE. It's at 2.1. So we think the Fed needs to be reformed. But the data is very, very clear. So Atlanta GDP came out today, negative 2.8.
Do you believe it?
What's that?
Do you believe it?
No, I think that's a little bit overstated. Our call is 1 to 2% growth. And it's important to keep in mind the first quarter is heavily distorted by not just seasonality, but weather. Since we live in the Northeast, we know it's been a very, very cold winter. So I wouldn't overreact to negative 2.8, but I think it'll get the Fed's attention. They'll start to figure it out. They're going to move slowly, but right now, MIPR is a good way to track it on the terminal. There's 3 cuts. We've been saying 3 cuts the whole year, even when people were super negative. But what we think happened really is political talking points masqueraded as economics. So we analyze tariffs, their sales tax, and they're actually deflationary / recessionary. So we just think the market completely was off. And now it's just going back to normal. And so we're bullish. Keep in mind that it's not earnings season too, so these huge sell-offs can happen, and we can all come up with reasons for it. But when we start earnings season again in April, we're pretty bullish on the market. We'll get more clarity on tariffs. I agree with your prior guests. We may not even get these 25% tariffs, by the way, are damaging.
Yeah.
It can ruin the North American supply chain, particularly for autos.
All right, well, we'll see what happens in the next couple of hours. A lot of people say the stock market is the traffic light for President Trump. It tells him whether to stop or to go. We've heard from Treasury Secretary Scott Bessent that he and they are looking more closely at the 10-year yield. With the 10-year yield now at 4.16%, the lowest since early December, what is the bond market telegraphing to the Trump administration?
Well, I do think that they're in a little bit of a bind, and we have been talking about the vulnerability of the Fed chair because their policy, I think are attractive in the long run, but in the short run, they're making this GDP crunch that the Fed is precipitating way worse. And so I wouldn't be surprised if there's increasing pressure on the Fed. We absolutely believe that Trump has the ability to legally fire the Fed chair. And so there might be a showdown as these policies crash together, and we do see even possibly a recession.
How does that influence how you think about and what to listen for from Jay Powell when he speaks this Friday?
Well, like I said, they're usually way behind the curve, so I wouldn't be too optimistic about that.
You're not looking for anything market moving from him?
I mean, hopefully he starts to, negative 2.8, like how do you ignore that?
Yeah.
But they seem to sort of be burned from creating the great inflation of 21 and being behind the curve there. Mm-hmm. So they seem to want to make two policy mistakes, but hopefully they soften the tone just a little bit over the next couple of weeks.
All right. Thank you so much. Jay Hatfield is CIO of Infrastructure Capital Advisors. Really appreciate your joining us today.
Thanks, Charlotte.
And, that goes back to the idea that there's a lot of items on the calendar for this week, right? We have JPL at the end of the week. We also have the jobs report at the end of the week. And it takes on extra importance given the ISM manufacturing numbers today.
Yeah. And I mean, one thing I like to look at, too, are also just the earnings themselves, because that gives you a little bit of a little bit more of a real-time read into some of those economic conditions. I feel like you get maybe sometimes a truer reflection of that out of the earnings and, more importantly, out of the CEO commentary.
Yeah.
And we're going to get a lot of consumer-facing companies this week, and of course, the main driver of our economy. So, you get the manufacturing sector. That's 10% of GDP. You talk about whether you're going to shop at Macy's or Target or Costco, and I know you're a Costco. You're probably keeping this economy afloat with how much you spend at Costco.
I just bought toilet paper on Saturday.
But in all seriousness, it gets to this idea. I want to hear what those CEOs have to say. So if they start saying, hey, we're worried about what's going to happen over the next couple of quarters, then I'm certainly going to be worried, probably much more so than whatever Jay Powell has to say.
And it goes back to what Walmart had said during its earnings call, right? Giving a warning for sales for 2025 because of geopolitics and uncertainty really weighing down on the consumer. And Walmart is the kind of place that people know they can go to get the best pricing. They know that the company has their back when it comes to looking for the best value.
Yeah, and this is going to be an interesting setup going into tomorrow. Of course, we keep talking about this idea. Maybe they reach a last-minute agreement before midnight. Maybe they don't. What happens if you wake up tomorrow morning and that 25, and now I guess 20 on China is still in place?
Yeah.
Then that becomes something that the market is going to have to pull up those spreadsheets and figure out how you model uncertain economic conditions.
Yeah, as Mexico's president said, everything is possible.
Yeah.
All right, coming up, we've got more on today's market sell-off with Sam Stovall. He is chief investment strategist at CFRA. We have the major indexes closing lower today, all by at least 1.5%. This is The Close on Bloomberg. All right, big sell-off today, and if you put it into context here, the S&P 500 still up almost 6% over the past 6 months, but we are only 1.1% away from falling below the close on Election Day, and remain, according to Michael Hartnett over Bank of America, if the S&P 500 falls below that level, investors are expecting verbal intervention from President Trump to support stocks.
Verbal intervention. Well, that's a big question, though, right? Remember, he was asked, it was a couple of weeks ago, like whether he cared about the market reaction. He said, no, I don't care. I mean, I don't know if I believe that, but it gets to this idea that the first term, this was all about what he did. Anytime the market reacted, he seemed to react himself, and that was kind of the put, if you will, to kind of keep things in check. I don't know if we have that right now.
Yeah, absolutely. All right, so let's bring in Sam Stovall, Chief Investment Strategist at CFRA, to talk a little bit more about where things stand in equity markets. Sam, first of all, I want to get your thoughts on today's sell-off. Was it orderly from where you sit?
Well, yes, I think so. I jokingly like to say that investors emulate fainting goats when they start to get worried about the market, whose legs freeze, and then they align perfectly into defensives over cyclicals. So consumer staples, healthcare, real estate, utilities were the best performers, whereas the cyclicals were the underperformers. But what's encouraging to me is that the defensives were up. They just weren't down by a lesser amount. So that implies that this is much more of a short-term reaction as they await the president's speech tomorrow night.
Okay, do you expect to hear anything from the president in his speech tomorrow that would give investors some confidence that the sell-offs we've been seeing with increasing frequency are fleeting?
I think that he's basically going to try to take credit for something tomorrow night to say that his threats of tariffs are working, and it'll remind investors that they're probably more rhetoric than they are reality. And even if we do see tariffs go into effect tomorrow, I think they're likely to be short term because the president really does not want to be tagged as the one who started a global recession. I think what he wants is really to negotiate things that will matter to him, and that would be done by the threats and short-term actions of tariffs.
I am curious, though, about market positioning, though, Sam, and because we talk about, obviously, the flight into some of those defensive sectors. That's been going on for a while. I mean, the best performers on the year are basically the sectors you mentioned, staples and healthcare and things like that. Is there any risk in those areas? And the reason why I ask is that sometimes what looks defensive can sometimes be a little bit of a trap. So if this does drag on, do you think investors will be rewarded for being in those spaces, or could that backfire?
Well, I think they will be rewarded, but you have to remember that a lot of this is going to be on a relative basis. Defensives still fall. In a bear market, there traditionally is no place to hide. The only two sectors that traditionally have posted average increases have been gold and alcohol. So everybody else, tobacco, food, etc., has fallen by simply a lower amount, or I should say a narrower decline relative to the more cyclical sectors of consumer discretionary, industrials, and materials.
Yeah, and we should just point out, as you speak, Sam Adams, Boston Beer, was up 1.8% today. So maybe you're onto something there here. And of course, gold also up about 1% in the spot market. In all seriousness, though, Sam, so we get back to this idea. It's been a long time since I can remember policy, or at least the threat of policy changes out of Washington, could drive the market as strongly as it does. And I do wonder if this could be different, the idea that there is a little bit more bite to some of this than bark.
Well, I mean, just to show you my age, I do remember the Hillary Gate, if you will, 1993, when the new administration was looking to curb healthcare costs, and that threw the market into a turmoil, threw the healthcare sector into a spin, and ended up making a tremendous buying opportunity for the longer term thereafter. So we could be seeing something right now, but right now we're really only down 5.1% since the recent high in early February. So I think we have a ways to go before we get really concerned about this market.
Sam, we've got Target closing down 2.8% today. They are scheduled to report earnings tomorrow, and we know that they've been doing a lot of things like cutting prices on select items, increasing their selection of goods to sell to consumers. Walmart has already made pretty clear that 2025 is going to be a tough year to forecast because consumers feel the pain of inflation and the possibility of tariffs. What is this retail earnings season going to look like when it comes to how receptive investors are to this low bar that companies will be trying to set?
Well, a good thing about low bar is that I find that management does an excellent job of managing expectations, and rarely do you injure yourself falling out of a basement window. So if earnings estimates are very, very low, which they have become for the first quarter of 2025, when this most recent earnings reporting period was started, consumer discretionary was expected to post a 10% gain in Q1 of 2025. Now it's a 0.6% advance. So there's been a lot of downward revisions in consumer discretionary. So Target and other areas are being hit quite hard.
What's your general expectation, though, Sam? I mean, I want to kind of circle back to corporate earnings because there's been a lot of fears in this market about policy and economic conditions, and that have been going on even before the Trump administration. And yet we kept seeing companies, at least the larger companies in the S&P 500, post-earnings quarters that seemed to suggest that they were, if not insulated from it, had found a way to ride that. And maybe that's just good management on their parts, or maybe it's something more here. We came out of earnings season that beat a lot of expectations, Sam. I mean, by a tremendous amount. And I know the bar was lower, but still they beat it. And is there any reason to expect that the current quarter end and when we get to the next earnings season will be any different?
Usually short-term forecasts tend to be exceeded because, as I mentioned, management does try to adjust analysts' expectations. Usually 12-month out, those numbers are a bit optimistic because almost anything looks good that far out. I would say encouragingly, because of the recent decline, and we are now just barely in pullback mode, now the premium on the S&P 500 is only a 15% based on its current PE on forward 12-month earnings versus only its 10-year average. And this number had been up 2025 fairly recently. So I think whatever declines we're experiencing will end up suiting nicely for the market's improvement probably in the second half.
Sam, I started off earlier talking with Romaine about how if the S&P 500 falls below its close on November 5th, election day, that investors are looking for some kind of verbal intervention from President Trump. Are the fundamentals of the market and the economy strong enough that some verbal intervention would be enough to stop this bout of volatility?
Well, I do sort of question whether we would get that kind of intervention, because he has said multiple times that, we're going to have to experience some pain. And so I would presume that pain is regarding the market itself. So I think in his second administration, he is willing to take some short-term pain in order to harvest some long-term gains later on.
All right, Sam, really appreciate you jumping on for us on a very incredible day. Whether you agree with what's going on in Washington or not, certainly big implications for everyone involved. Sam Stovall, Chief Investment Strategist over at CFRA.
And that idea that he said the president's willing to take some short-term pain for long-term gain. Scott Bessent, the Treasury Secretary, spoke with Bloomberg on Friday, and he was saying that Trump doesn't own the economy until 6 to 12 months in. So right now, they can point to inflation or manufacturing slowing down as still something left over from the Biden era. Yeah,
it was a great interview that David did. And it gets to this idea, though, too, of whether this is a reason why they've been so urgent, if you will, in getting some of this stuff. And there's been a lot of speculation about even with some of the firings or the potential firings out of the federal government, the timing of that was structured in a way to sort of lessen, I guess, where the blame gets assigned for any fault.
Do it in the first couple months. All right, let's just recap how markets closed on the day. The S&P 500 losing 1.8%, closing off its lows, but still a pretty big sell-off nonetheless, as President Trump confirmed that they will go ahead with the tariffs on Mexico and Canada tomorrow. And of course, you saw buying in treasuries, the 10-year yield coming down 4 basis points, dollar weaker, especially against the Mexican peso and the Canadian dollar. And European stocks, they've been the bright spot.
European stocks were the bright spot earlier in the session. And we should point out in the after-hours trade, keep an eye on the broad markets. Futures, believe it or not, actually getting a slight bid here in the U.S.
This is The Close on Bloomberg.
Right across the screen here on this Monday afternoon, the worst day for the S&P 500 all year long, and this all seems to be tied to what's been going on in Washington. That promise that President Trump had made coming into his new term that he would impose tariffs on our two biggest allies, Mexico and Canada. He says that will take effect later tonight, barring some last-minute negotiations. But according to him, his own words, he says, well, there's not much room for negotiation at this point. The market reaction was swift. Rebecca Patterson joins us right now. She was the former chief investment strategist at Bridgewater Associates and, of course, has held investment strategy positions at a couple other notable places like J.P. Morgan and elsewhere. I know you're technically not in that world anymore, Rebecca, but I am curious as how you approach a day like this. If you had to go into an investment committee meeting tonight or tomorrow morning here, particularly after those tariffs go into effect, assuming they do, what do you say?
Well, the challenge with President Trump and this administration is that we have no confidence in how long the tariffs will be in place, how high they'll go, how broad they'll get when we get those reports back to the executive branch at the beginning of April and what could follow that. So the key word that we hear all the time right now is just uncertainty. But that uncertainty, regardless of these tariffs potentially taking effect tomorrow, which will absolutely be a cost to the consumer and to corporate profits, we just don't know the degree, but we know the direction. The uncertainty is the big deal. And we're starting to see it show up on and on. Consumer sentiment surveys, business sentiment surveys. What was worrying to me about the latest round of surveys was that we had capital expenditure expectations for January from all 5 Fed regional surveys going down. So companies are saying they're going to spend less. Yeah. So that's the problem. When confidence falls, it is a leading indicator for activity. We don't know how much softer the economy will get, but we know the direction. And so what we're seeing today is that's getting priced into the markets.
Yeah, we've seen some data, at least when it comes to the potential impact on our trading partners, Canada and Mexico, as to what the hit would be on their GDP. I am curious, though, about what the potential response could be here within the United States. And I'm really talking about the Fed and the reaction function and their sort of mandate to kind of create price stability, to obviously facilitate, and keeping inflation sort of near their target here. They're going to be asked a lot of questions. They got a big meeting in about 3 weeks. We're going to get a lot of speeches this week, including from Jay Powell himself. And I know tomorrow we get the New York Fed president as well. And they can't continue dodging these questions about whether the Fed will do something in anticipation of that economic impact. Should they?
No, they absolutely cannot front run what the White House and this government is going to do. They have to take those things as a given once they have the facts. That's how they achieve their independence. However, I am confident that behind the scenes, there's analysis going on, as we saw in 2017 and 2018, about what the possible impacts of things like tariffs are on the economy. The Fed produces something called a Teal book. And if you go back and look at 2018, they talked about different scenarios of the effects tariffs could have on the economy. So that research, again, I would be confident is happening again. So they're trying to understand the linkages, what the fallout could be, and that'll shape their decision making in the meetings to come. I do think Powell will be particularly important this Friday. He's speaking about 4 hours after that non-farm payroll data comes out. The job market's been still very solid despite that latest jobless claims report. If we continue to get a solid labor market, then the Fed can stay focused on inflation, which continues to be sticky, and we are seeing inflation expectations nudge up slightly. That's something the Fed's going to be very focused on. But on the other side, right, you saw OPEC today moving towards supply increases, and we saw oil prices selling off on that. All else equal, that's going to push inflation expectations lower. So we have a lot of tug of war going on the inflation side. I think for now, that's still the Fed's main focus.
About 3 weeks ago, Rebecca, you were on the close with us, and you had said that stagflation is the biggest market risk. We got a U.S. ISM manufacturing report today that wasn't pretty. Manufacturing nearing stagnation, prices jumped, employment dipped below that 50 line, new orders dipped below that 50 line. Does that put us in the direction of getting to stagflation?
Well, it's interesting. What you're seeing right now are the Fed funds futures pricing in more rate cuts. So that would suggest that the market believes the Fed will respond to stagflation with rate cuts, that inflation won't rise enough, that it prevents the Fed from easing, that growth will be the bigger deal. We'll see how that plays out. I think the ISM service sector survey, which comes out later this week, super important. The service sector, as we all know, is a much bigger share of GDP than the manufacturing sector. So while today's news on the manufacturing side was worse than expected, what we see later this week on the service side is going to be a lot more meaningful to understand what's going on in the broader economy. Remember, too, the consumer had a pretty strong fourth quarter. Consumer spending was up annualized over 4%. So seeing the consumer pull back is not a surprise. It's the confidence hit that I'm more worried about as we look forward. I do think stagflation is still a risk for this year. At the moment, though, we need to see, again, if tariffs come forward, how much retaliation do we get? How much does that push up prices? I think we all know the direction. It's just going to be a matter of degree and how quickly that happens. The market's different this time than 2017 and 18. I know Treasury Secretary Bessent said we didn't see a big impact last time, but we've had the pandemic since and that inflation shock. And I think consumers and businesses are much more aware of inflation risks today and therefore are going to respond a lot faster than they did last time.
So in the last couple of weeks, there's been percolating talk about how there's a growth scare. Has that growth scare since turned into something more concrete?
I don't think so yet. Again, Friday's payroll data will be pretty important to have some hard data on top of this sentiment data to see if the labor market is holding up. The consensus is looking for a recovery in February in the jobs after January's slowdown, which we know was one-off events. It was weather related. It was wildfire related. So if we don't get that recovery this month, that could start to make people think that this growth scare is real. I know there's a lot of focus right now on the Atlanta Fed Now estimate, which has gone sharply negative in the last few days. A lot of that is mathematical, how we account for imports. It doesn't suggest that GDP is actually contracting that much. I would expect it'll bounce back, but still, the point here is that we are looking at a moderation in growth versus what we had last year, and that is being caused more than anything else so far by uncertainty. And unless President Trump changes how he does business with other countries, I think this is going to be a feature of the next 4 years, and companies and investors are going to just have to get used to navigating it. I think it means lower returns on the S&P this year versus last year because that uncertainty is going to act as a bit of a obstacle, frankly.
Yeah, well, Rebecca, I think we all hope that there are at least returns and not the worst here. Rebecca, always insightful, always a wonderful conversation. Rebecca Patterson, economist and and former chief investment strategist over at Bridgewater Associates. All right, a lot is going on today, and there's going to be a lot going on tomorrow. Stick around. We're going to set you up for what to watch. This is Bloomberg. All right, as we focus on trade, why not focus on China? President Xi Jinping heading into China's National People's Congress this week, this after U.S. President Trump signed an order to raise the tariff on China to 20%. Enda Curran joins us right now from our Bloomberg Bureau in Washington. And Enda, I mean, there's so much talk about the President of the United States giving his State of the Union, but I think we got to pay attention to what Xi Jinping has to say. What will he say?
Yeah, it's kind of the equivalent almost to Chinese State of the Union, so to speak, remain. It's a very important week. It sets out the economic planning for the year for the Chinese economy. The focus, I think, is expected to be on how much support are the authorities willing to put into the economy. As you know, there's been a big slowdown there. The real estate sector has been in a lot of trouble. So there's expectation that perhaps the government will start to spend a lot more money, put fiscal stimulus into the economy, and of course, perhaps signal how they plan to respond to any trade war. It's a timely meeting because it comes just when these new tariffs on China and an additional 10% of tariffs on top of the last month's 10% of tariffs on all Chinese goods goes into effect tonight. So it will be the first opportunity we get to see how policymakers will respond and just how much support they're willing to put into their economy in response.
Yeah, as much as people say that anything could happen between now and when the tariffs on Mexico and Canada are set to begin, they're pretty certain that the ones on China are going to go through. And we know that China has talked a lot about this GDP target of 5%. Is that still the number to watch for here?
I mean, it is. It's a politically important number. The authorities haven't shown any sign of wanting to retreat from that. But of course, we know there's a lot of skepticism around whether or not the authorities do hit their growth target and whether or not they can hit it again in the year ahead. But I think the point is that the signal and the messaging coming from this week's meeting is expected to be one of something of a reboot for the economy with more support coming from the government.
Just real quickly, and when we talk about the tariff impact of the tariffs on China from the U.S., has China's economy sort of, I guess, turned enough inward where it's insulated from that impact?
It has some insulation, but no, it's still the world's biggest exporter. Its trade surplus has boomed over the past year. It relies on the U.S. as a key consumer, final consumer of its goods. So, you know, tariffs now of 20% across the board on all Chinese goods will have an impact.
All right, Enda Curran in our Washington bureau there, keeping an eye on what's going to take place in Beijing over the next couple of days. Meanwhile, as we set you up for what to watch tomorrow back here in the U.S., the President of the United States scheduled to speak.
Yeah, that'll be tomorrow evening. And of course, we will have special coverage of it starting at 8 p.m. New York time. President Trump addressing Congress. It's not so much a State of the Union as he is going to lay out his plan, at least to Congress.
Yeah, absolutely. And I think we kind of know the plan, but it's kind of made even more important by the idea that those tariffs technically are supposed to go into effect overnight here. So he'll certainly have something to talk about, or maybe he won't. Also going on tomorrow, Scarlet Fu, Bloomberg Invest.
Yes, Bloomberg Invest. And in fact, we'll have a Fed speaker. So we get our daily dose of Fed speak. John Williams, the New York Fed president, will be speaking. Also, Steve Mnuchin, former Trump administration Treasury Secretary, Gary Cohn as well, and Don Fitzpatrick. All of that, a great lineup coming up.
Yeah, and we should point out Bloomberg Invest, a real full lineup over 2 days here. I hope you tune in right here on Bloomberg Television for that, or on your Bloomberg terminal. We're also going to get some earnings, Scarlett.
We do. We're going to get Target in the morning, Nordstrom in the afternoon, Best Buy in the morning as well. So retail earnings really coming through.
Yeah, and that could have a big impact on the market as well. Scarlett and I will be back tomorrow. Of course, we're going to cover those earnings in the evening, but of course, also the ripple effect from what happens in the morning here. All your market moving coverage can be found right here on The Close. In the meantime, stick around. A lot of politics talk coming up next. Joe and Kaylee on standby for Balance of Power. This is Bloomberg.